You're likely sitting on a mountain of home equity. Thanks to this, homeowners have a staggering amount of wealth tied up in their homes, with total equity for those with a mortgage hitting $17.1 trillion dollars in the third quarter of 2025. And now you're thinking about putting that equity to work? Maybe for that dream kitchen, to wipe out high interest debt, or just to have a cash cushion for whatever life throws your way. But there's a catch. The world has changed. The party of ultra low interest rates is officially over. We're now living in a high rate world, and the old rules for borrowing against your home are out the window. The strategies that were a no brainer just a few years ago could be a costly mistake today. In 2025, making the wrong choice between a home equity loan and a home equity line of credit could cost you thousands of dollars in extra interest. In this video, we're going to cut through the confusion. As a mortgage professional who deals with this market every single day, I'm going to show you the smartest way to tap into your home's equity right now. We'll break down the new rules for borrowing in this high-rate environment, do a head-to-head comparison of your two main options, and give you a clear framework to make the best decision for your money. Stick around, because getting this right is more important now than ever. Let's set the stage, because it's a tale of two extremes. On one hand, you have record housing wealth. A tight housing market has kept home prices elevated, meaning your equity position is probably stronger than it's ever been. But on the other hand, the cost to access that equity has skyrocketed. For nearly 15 years, borrowing money was cheap. The Federal Reserve kept its benchmark rate near zero, which made mortgages, car loans, and especially home equity products incredibly affordable. Homeowners could grab a HELOC with a rate in the 3s or 4s and use it like a low-cost credit card. It was easy. That game is over. To fight inflation, the Fed aggressively raised its benchmark interest rate. While we've seen a few small cuts since the peak, we are nowhere near the rock-bottom rates of the past. This new, higher-for-longer interest rate environment is here to stay for the foreseeable future. This creates a massive dilemma. You have all this wealth locked in your house, but the key to unlock it, a loan, now comes with a much higher price tag. The number of people taking out home equity loans has surged as they look to use this wealth. But choosing the wrong product in this environment doesn't just mean a slightly higher payment, it can mean a difference of tens of thousands of dollars over the life of the loan. The new rules aren't about some secret loan product. The new rules are about strategy. It's about understanding the trade-offs between a predictable, fixed-rate loan and a flexible, variable rate line of credit in a world where interest rate risk is very real. It's about knowing how to manage that risk. So, let's put your two primary options under the microscope and see how they stack up in 2025. First up is the traditional home equity loan. I call this the predictable powerhouse. The easiest way to think of it is as a second mortgage. You borrow a lump sum of money, paid out to you all at once. In return, you agree to pay it back over a fixed period, usually 5 to 30 years, at a fixed interest rate. The key word here is fixed. Your interest rate never changes. Your monthly payment of principal and interest never changes. From the day you sign the papers until the loan is paid off, you know exactly what your payment will be. That predictability is its greatest strength, especially in a shaky economy. As of late 2025, national average rates for home equity loans are hovering around 8%, though some lenders offer rates in the low to mid 7% range for well-qualified borrowers with great credit and a low loan-to-value ratio. So when does a home equity loan make the most sense? It's the perfect tool for large, one-time expenses where you know the total cost up front. Let's use an example. Imagine you want to do a major kitchen and bathroom remodel, and your quotes total $80,000. You need the money now to pay the contractor and get materials. A home equity loan is ideal here. You apply for an $80,000 home equity loan. Let's say you get a 15-year fixed term at a competitive 7.5% interest rate. That gives you a monthly payment of about $741. That payment will be $741 every single month for the next 15 years. You can budget for it perfectly. No surprises, no wondering if the Fed's next move will send your payment soaring. You get your $80,000, finish your project, and settle into a predictable repayment schedule. Debt consolidation is another classic use case. If you have a bunch of high-interest credit cards at 20% or more, using a 7.5% home equity loan to pay them all off can save you a fortune and simplify your life with one lower monthly payment. What's the catch? Rigidity. You borrow the full $80,000 and you start paying interest on the full $80,000 from day one. And if you suddenly need another $10,000 for an unexpected problem during the renovation, you can't just draw more money. You'd have to apply for a whole new loan. Think of the home equity loan as a precision tool for a known expense. It offers stability in exchange for flexibility. Now let's flip the coin and talk about the home equity line of credit, or HELOC. If the home equity loan is a second mortgage, the HELOC is like a giant credit card with your house as collateral. Instead of a lump sum, a lender approves you for a credit limit, say $100,000. You can then borrow from this line as needed. Draw $20,000 one month, nothing the next, and another $5,000 a few months later. As you pay back what you borrowed, you can borrow it again. It's a revolving line of credit. This flexibility is the HELOC's superpower. But it comes with a huge trade-off: a variable interest rate. Most HELOC rates are tied to the U.S. prime rate, which moves with the Federal Reserve's benchmark rate. Your rate is calculated as prime plus a margin. The bank's margin is fixed, but as the prime rate goes up or down, so does your interest rate and your payment. As of late 2025, national average HELOC rates are around 7.6%, but they can range widely from the low 7% range to over 10%, depending on the lender and your credit. A HELOC works in two phases. First is the draw period, typically 10 years. During this time, you can borrow and repay as you wish. Many lenders also allow for interest-only payments. This means if you have a $50,000 balance at an 8% rate, your minimum monthly payment would only be the interest, about $333. This is great for short-term cash flow, but you aren't paying down the actual money you borrowed. After the draw period ends, the loan enters the repayment period, often for the next 20 years. You can no longer borrow money. Your outstanding balance is converted into a fully amortizing loan, and you have to start paying back both principal and interest. This is where payment shock can ambush you. That $333 interest-only payment on your $50,000 balance could suddenly jump to over $400 or $500 per month as principal is added in. And that's if the interest rate hasn't gone up. A HELOC is best for situations where you don't know exactly how much money you'll need or when you'll need it. Think of a multi-stage renovation, ongoing tuition payments, or simply having a big, flexible emergency fund on standby. You only pay interest on the money you actually use, which is a huge advantage. But the risk is clear. In a rising rate environment, that attractive starting rate on your HELOC can climb, and your monthly payments can become unpredictable. The flexibility you gain comes at the price of uncertainty. By the way, if you're finding this breakdown helpful and it's clearing up some of the confusion, do me a favor and hit that like button. It really helps the channel reach and help more homeowners just like you. And if you have a specific question, drop it in the comments below. I do my best to answer every single one. You take out a $50,000 home equity loan with a 10-year fixed term. Let's use a competitive fixed rate available today, say 7.25%. Interest rate, 7.25% fixed for 10 years. Monthly payment. Your principal and interest payment would be $587 per month. Total interest paid. Over 10 years, you would pay approximately $20,440 in interest. The beauty here is the certainty. Your payment is $587 this month, next month, and 10 years from now. It doesn't matter what the economy does. Your budget is locked in. Option 2, the HELOC. You open a $50,000 HELOC. The bank offers a variable rate of prime plus 1%, and the current prime rate makes your starting APR 7.81%. Interest rate, 7.81% variable, and it can change. Monthly payment, interest only. During the draw period, your minimum payment is just the interest, which is about $325 per month. Monthly payment, fully amortizing over 10 years. If you chose to pay it off over 10 years like the loan, your payment would start at around $602 per month. Looking at these numbers, the interest-only HELOC payment looks tempting, doesn't it? But hold on, this is the classic trap. That 7.81% rate isn't guaranteed. If the prime rate were to increase by just 1% over the next few years, your HELOC rate would jump to 8.81%. Your fully amortizing payment would then climb to over $628 per month, significantly more than the fixed home equity loan payment. You're trading initial savings for long-term risk. The new rule game changer, the fixed rate conversion option. This is where a crucial strategic tool comes in, one that's become incredibly important, the HELOC fixed rate conversion option. This isn't a new invention, but its strategic value has skyrocketed. Many, but not all, lenders now offer the ability to lock in a fixed interest rate on all or part of your outstanding HELOC balance. Think of it as a hybrid approach that can give you the best of both worlds. Here's how it works. You use the HELOC for its flexibility. Let's say you draw $30,000 for the first phase of a project. You're paying a variable rate on that amount. But you get nervous about rates rising. You can contact your lender and convert that $30,000 balance into a fixed rate loan with a set repayment term. That portion of your debt is now locked in. You can still draw from the remaining $20,000 on your HELOC at a variable rate. Some lenders even let you do this multiple times. This strategy lets you use the HELOC for its intended purpose, but then hedge against rate risk by locking in your debt as you go. The fixed rate you get will likely be higher than your initial variable rate, but it provides the payment certainty of a home equity loan. This feature has become a non-negotiable for anyone considering a HELOC in 2025. You absolutely must ask your lender if they offer a fixed rate conversion option and if there are any fees. So how do you choose? It all comes down to your needs, your project, and your personal tolerance for risk. Let's make it simple. You should lean toward a home equity loan if you need one big lump sum of cash, you're doing one major project, or consolidating a large amount of debt, and you know the exact dollar amount you need. You are a set it and forget it person who values budget certainty above all. The thought of your monthly payment changing makes you anxious. You want to know your payment will be the same every single month, period. You believe today's rates, while high, might be the lowest you'll see for a while. If you think rates are more likely to go up than down, locking in a fixed rate is a smart defensive move. You should lean toward a HELOC if you need funds over time. You have a project with multiple stages, ongoing expenses like tuition, or you just want a financial safety net you can access on demand. You only want to pay interest on the money you actually use. If you open a $100,000 line, but only use $10,000, you only pay interest on that $10,000. It's far more efficient for staged funding needs. You can tolerate interest rate risk. Or your lender offers a strong fixed rate conversion option. This is the key. If you get a HELOC, you're either comfortable with your payment changing, or you have a plan to use that fixed rate lock as your escape hatch. For most people, the decision hangs on that trade-off. The home equity loan's ironclad predictability versus the HELOC's powerful flexibility, moderated by that crucial fixed-rate conversion strategy. You only want to pay interest on the money you actually use. If you open a $100,000 line but only use $10,000, you only pay interest on that $10,000. It's far more efficient for staged funding needs. You can tolerate interest rate risk, or your lender offers a strong fixed-rate conversion option. This is the key. If you get a HELOC, you're either comfortable with your payment changing, or you have a plan to use that fixed-rate lock as your escape hatch. For most people, the decision hangs on that trade-off. The home equity loan's ironclad predictability versus the HELOC's powerful flexibility, moderated by that crucial fixed-rate conversion strategy. So, what's the final call in the battle of home equity loan versus HELOC in 2025? The truth is, there's no single champion. In this high-rate world, the winning move isn't choosing the best product. It's about choosing the right tool for your specific job. The home equity loan is your sledgehammer, a powerful, direct tool for a big, one-time task where you need stability. The HELOC is your multi-tool, incredibly versatile, but that variable rate blade requires more skill to handle safely. The fixed rate conversion option is the safety guard on that multi-tool, and you shouldn't leave the store without it. The most important takeaway is this: you have to shop around. Get quotes for both types of loans from at least 3 different lenders. Include local credit unions and online banks. Ask detailed questions. What is the current rate? For a HELOC, what is the index and the margin? Is there an annual fee? And most importantly, do you offer a fixed rate conversion option? What are the terms, and are there fees to use it? Navigating your home's equity is one of the biggest financial decisions you'll make. The rules have changed, but with the right strategy, you can still make that equity work for you. If you're a homeowner trying to figure out the best path forward, the next step is to talk to a professional who can look at your unique situation. I've put a link in the description where you can schedule a complimentary, no-obligation consultation with my team. We can run the numbers for you and help you build a strategy that fits your life. Thanks for watching. Now go put your equity to work wisely. So, what's the final call in the battle of home equity loan versus HELOC in 2025? The truth is, there's no single champion. In this high-rate world, the winning move isn't choosing the best product. It's about choosing the right tool for your specific job. The home equity loan is your sledgehammer, a powerful, direct tool for a big, one-time task where you need stability. The HELOC is your multi-tool, incredibly versatile, but that variable rate blade requires more skill to handle safely. The fixed rate conversion option is the safety guard on that multi-tool, and you shouldn't leave the store without it. The most important takeaway is this: you have to shop around. Get quotes for both types of loans from at least 3 different lenders. Include local credit unions and online banks. Ask detailed questions. What is the current rate? For a HELOC, what is the index and the margin? Is there an annual fee? And most importantly, do you offer a fixed rate conversion option? What are the terms, and are there fees to use it? Navigating your home's equity is one of the biggest financial decisions you'll make. The rules have changed, but with the right strategy, you can still make that equity work for you. If you're a homeowner trying to figure out the best path forward, the next step is to talk to a professional who can look at your unique situation. I've put a link in the description where you can schedule a complimentary, no-obligation consultation with my team. We can run the numbers for you and help you build a strategy that fits your life. Thanks for watching. Now go put your equity to work wisely.